MicroStrategy Inc. is trading at 186.47 USD, showing an intraday gain of 13.48 or 7.80% as of late morning trading on Wednesday, January 14, 2026. This sharp upward movement comes at a moment when the broader tech sector is showing significant mixed signals, with Nvidia stock and Tesla stock facing some selling pressure, while Apple stock remains relatively flat. While most traders looking at their Robinhood app might see this as just another green day for the world's largest corporate holder of digital assets, there is a much more complex and perhaps dangerous structural story developing beneath the surface. The hidden insight that many are missing today is the compression of the premium. For years, investors were willing to pay a massive premium over the net asset value of the actual holdings the company keeps on its balance sheet. But as we sit here today, that premium is being tested by institutional forces that could either cement this company's place in the major indices or force a massive liquidation event. The general expectation in the market right now is that as long as digital assets go up, this company goes up even faster. People view it as a leveraged bet. However, the reality is that the structural engineering of their debt is starting to create a situation where the company is no longer just a proxy for a single asset, but a test case for how much debt a balance sheet can handle before the traditional investment world pushes back. Tomorrow, January 15th, is a date that is likely keeping the management team up at night. The MSCI is set to make a decision on whether firms that primarily hold digital assets can remain in their major global indices. If they are removed, we are looking at billions in forced selling from passive funds that have no choice but to follow the index rules. This is the tension between what retail investors believe, that the moon is the only destination, and the reality of institutional index mechanics. If you look at the activity on major platforms like Interactive Brokers or through a Fidelity trading platform, you can see that institutional volume is starting to dwarf the retail crowd. People using a Fidelity brokerage or managed Fidelity wealth management accounts are increasingly seeing this stock pop up in their portfolios, often without realizing how much risk they are carrying relative to the legacy software business. While you might be comfortable doing some self-investing or using investing sites to pick winners, the scale of the moves we are seeing today suggests that the big players are positioning themselves ahead of tomorrow's index announcement. The stock is outperforming the S&P 500 significantly today, which is a classic sign of a pre-event squeeze. Investors are betting that the MSCI will blink and keep the stock included, which would likely trigger even more buying from those using Schwab Intelligent Portfolios or other automated online investment tools. The recent movement has been nothing short of a roller coaster. Just a few weeks ago, the sentiment was incredibly bleak as the underlying asset prices pulled back from their highs. We saw a massive unrealized loss reported for the fourth quarter of 2025, which really spooked the traditionalists. But in true fashion, the leadership decided to double down, purchasing over $1 billion more of the asset in the first week of 2026. They are using the proceeds from share sales and preferred stock to keep the engine running. This is a bold strategy, but it raises questions about the long-term sustainability of the individual brokerage accounts that are heavily weighted in this single name. If you are someone who likes to invest online and manage your own risk, you have to ask yourself if you are comfortable with a company that is essentially a high beta fund with a small software company attached to its side. Comparing this to other major tech players provides a lot of context. When you look at Nvidia stock, you are looking at a company that generates massive cash flow from selling physical hardware and software services to the entire world. When you look at Apple stock, you are seeing a consumer titan with a massive cash pile and a loyal user base. These are the pillars of the NASDAQ. MicroStrategy, on the other hand, is a different beast entirely. It has become a vehicle for a specific kind of financial engineering. Some might call it genius, others might call it reckless, but it is certainly not boring. The trading volume today is exceptionally high, which indicates that we are seeing a lot of turnover between different types of holders. The people who bought in years ago are likely trimming their positions, while new institutional buyers, perhaps those looking for exposure through Fidelity ETFs or Fidelity mutual funds, are stepping in to fill the gap. For those using a Robinhood trading platform or exploring Robinhood investments, the volatility is the main draw. You can buy Robinhood fractional shares of this stock, which makes it accessible even if the price is high. But that accessibility also means that the stock is prone to sudden, sharp moves driven by social sentiment and retail momentum. We are seeing a lot of discussion today on various investing sites about whether this is a buy the rumor, sell the news situation ahead of tomorrow. If the MSCI decides to exclude digital asset treasury firms, the downward pressure could be intense. On the flip side, a positive decision could send the stock towards new highs, potentially surpassing the peak it saw last summer. This is why the online investing community is so divided right now. Let's talk about the business model for a moment, because it often gets lost in the noise. At its core, it used to be a pure-play enterprise analytics software company. They still have that business, and it still generates revenue, but the margins are thin and the growth is modest compared to the giants of the sector. The real business now is the management of their treasury. They have issued billions in convertible notes with very low or even zero interest rates. Then they take that cash and buy more digital assets. As long as the value of those assets grows faster than the interest on the debt, the math works beautifully. It's a way to create value for shareholders without needing to sell more products or find more customers in the traditional sense. But this model requires a constant upward trajectory in the underlying asset. If things go sideways for a long time, the debt becomes a weight that could eventually pull the whole structure down. The institutional interest is the most important part of the story right now. We are seeing more and more traditional firms provide investment help to their clients regarding this stock. Whether it is through Fidelity IRAs or specialized accounts at Interactive Brokers, the professional world is having to take a stand. They can no longer ignore a company that has become such a large part of the small and mid-cap indices. This is why the MSCI decision is so critical. It's about more than just one stock. It's about the definition of what an operating company is in the modern age. If the index providers decide that holding assets is not the same as operating a business, it could change the landscape for many other firms that are trying to follow this same path. I want to hear from you on this. Comment below how many shares of this stock you are currently holding in your portfolio, and let me know if you think the MSCI will keep them in the index or kick them out tomorrow. Your perspective on these institutional shifts is what makes this community so valuable, so don't hold back. Looking at the future outlook, there are a few scenarios that could play out over the next few months. In the best-case scenario, the MSCI keeps the stock in, the underlying digital assets continue their recovery, and the company continues to use its high stock price to raise even more capital to buy more assets. This creates a virtuous cycle where the stock price drives more asset purchases, which in turn drives the stock price higher. This is the scenario that the bulls are betting on today as the price climbs toward the $190 mark. It's a path that has worked for several years, and they see no reason why it should stop now, especially with more institutional products coming to market every day. The middle ground scenario is of stagnation. If the MSCI delays its decision or if the market enters a period of low volatility, the stock could trade sideways for a long time. This would be difficult for the company because they rely on a high stock price to continue their capital raising efforts. Without the ability to issue new shares at a premium, their growth as an asset holder slows down significantly. In this situation, the software business would have to carry more of the weight, which it is currently not equipped to do. Investors using a SoFi robo-advisor or other automated online investment tools might see their allocations shift away from this name if the momentum starts to fade. The worst-case scenario is the one the bears are constantly warning about. If we see a combination of index exclusion and a significant drop in the underlying asset value, the leverage spiral could work in reverse. The company has a significant amount of debt that will eventually come due. If the stock price is below the conversion price and the assets aren't worth enough to cover the principal, they would be forced into a very difficult position. They might have to sell their assets at the worst possible time or undergo a painful restructuring. This is the reality that often gets overshadowed by the excitement of a 7 or 8% daily gain. It is the risk that sits in the background of every individual brokerage account that is long on this stock. As we wrap up today's analysis, let's look at where we stand. The intraday movement is strong, fueled by a mixture of retail enthusiasm and institutional positioning. The comparison to other leaders like Nvidia stock and Tesla stock shows that this company is currently playing by different sets of rules. While the tech giants are tied to the global economy and the development of artificial intelligence, this company is tied to a specific financial theory and the performance of a single asset class. The contrast between expectation and reality has never been sharper.